Hey everybody, I'm Kyla. Welcome to my channel where I talk about the stock market and the economy amongst other things. Today I wanted to talk about the labor market and the numbers that we saw today and how the Federal Reserve is going to think about that moving forward. Also want to talk about how those numbers are sort of unreliable, but it doesn't matter because the Fed cares about them. So how the Fed thinks about things. The Fed has a dual mandate of price stability and maximum employment, and right now maximum employment is becoming a lever for them to manage price stability. So they're like, hey, we want to see major softening in this jobs market. We just want to see companies slowing it down. We want to see people slowing it down. So they raise rates for people to stop demanding things. It becomes more expensive to demand things. Mortgage rates go up, etc. And inflation hypothetically would go down. Within that concept of stop demanding stuff, a softer labor market would equate to people not buying as much. Can't buy as many things if you don't have a job. A softer labor market would also equate to companies not growing as much, right? But the labor market is sort of weird. We're seeing headcount slashing from Meta, from Amazon, from tech companies, from finance companies, but we're seeing huge increases in jobs and wage increases in construction and utilities and mining and services and retail jobs, etc., because they need people, right? So it's sort of becoming a bifurcation of the labor market. What happened with like construction, utilities, mining, etc., is they fired so many people during the pandemic that essentially it became you can't fire what you didn't hire. So we are seeing some aspects of it beginning to soften, tech and finance. However, some parts of it are still really strong. There's two main ways to have a soft landing in the labor market. The first one would be layoffs, so people losing their jobs, unemployment ticking up because of that, companies cutting people, etc. The other would be an increase in the labor force participation rate, so the number of people who are actually out there like looking for jobs. More people coming back into the labor market, which would work to push the unemployment number down, but wouldn't be people losing their jobs necessarily. It'd just be a different way for the labor market to soften. So what happened with the jobs number today? Today we got the JOLTS report, and job openings fell 1.1 million to 10.1 million, which was the biggest drop, the larger than the drop in job openings in March 2020 when that pandemic hit, right? The number of private sector job openings fell by almost 10%. So it was a pretty big drop in job openings, number of jobs that are available, and job openings are what the Fed looks to see if, their policy is working. And you can also see this in other metrics. So job postings on Indeed for 7 days or less were 55% above pre-pandemic baseline. However, a month before they were 62%. So even in those more, qualitative metrics, you're starting to see just a softening in the labor market. And the labor market metric that Jerome Powell likes to look at, the ratio of job openings to unemployed workers, fell from 1.7 to 2. So instead of there being 2 job openings for every 1 unemployed person, there's now 1.7 job openings. Most of the decline in this metric has come from fewer job openings. The part that is from higher unemployment has been from workers entering the labor force. So going back to that 2 ways to have a soft landing, you're starting to see that increase in the labor force participation rate working within the labor market itself and leading to that softer labor market. And as Nick from the Wall Street Journal highlights, this is what Powell wants. Job openings could come down significantly, and they need to without as much of an increase in employment as that has happened in earlier episodes, because there can be this reliance on labor force participation rate increasing. There's still people hiring, but the number of job openings has decreased, which is creating that softer labor market, which could lead to a soft landing for the Federal Reserve. And the Fed is like, yeah, this is awesome. However, Employ America has written extensively about openings, and other people have said this too. Openings are not that great of a metric for how the labor market is actually performing. So that's definitely something to keep in mind. But now the market is like, the Fed's gonna pivot. Yay, we're seeing a softer labor market. Let's freaking go. We've seen 2 central banks pivot so far. Australia pivoted this morning, and the Bank of England sort of pivoted last week, right? So we're starting to see some central banks beginning to be like, all right, okay. And also we saw municipal bonds be like, all right, like we think the Fed's gonna also moderate the pace here, but the Fed is unlikely to pivot just yet. Most likely there was a paper from John Williams who spoke at a conference, and it was a bedrock commitment to price stability. And at the very end of the talk, he says, tighter monetary policy has begun to cool demand and reduce inflationary pressures, but our job is not done yet. It will take time, but I am fully confident we will return to a sustained period of price stability. I went on Plain English with Derek Thompson and talked about this with him also, but basically the idea here is that the Fed has their toolkit, raising rates, shrinking the balance sheet, but they also have to worry about credibility. They have to make sure that the stock market believes the words that they say. That is super important to them, and it's important to how they function, right? So we are seeing a lot of softening in inflation metrics. Rents are mega weakening right now. Rent prices going down. Health insurance is probably going to drag the CPI lower too. do. And JP Morgan is out here. Who's going to buy all these bonds, Fed? We don't have the Fed as a buyer anymore. This is wild. So you're starting to see what the Fed wants beginning to show up, but it's probably going to take a little bit, maybe, I'm not sure, for the Fed to actually pivot on what they're saying because they are very concerned about their credibility, which is a huge part of their toolkit. Basically, we saw a softening in the labor market according to what the Fed looks at and what the Fed wants to see. But does it mean that the Fed is going to do a complete 180? There's still more to be done and they have to preserve that credibility. So that's what happened, showing that there's a way to do this without it being actually really detrimental. Hope you're doing okay out there. Thanks for listening. I'm on Instagram, YouTube, Substack, TikTok. I'll talk to y'all soon. Bye.